All right. We are live and live streaming. So today's topic is DSCR loans. And we've talked about this a few times and even mentioned it last week briefly when we were talking about 7 different non-QM programs and products and options to help more clients. And I thought this would be a great follow-up to that. And I thought it would also be great to have our DSCR specialist, Taylor, on as well. And so we're gonna cover all things DSCR, what it is, how to calculate it, what a checklist looks like as far as what a borrower needs, and then some of the guidelines or qualifications and other things that might be red flags or deal breakers as far as this type of loan program or option goes. Some housekeeping items before I better introduce Taylor. Number one, the recording or replay of this will be available immediately afterwards on demand at the same link that you registered at. We'll also get the replay on our YouTube channel, Wake Up Real Estate, as well as on our website, wakeup.realestate. That'll be up there in the next probably 24 to 48 hours or so. So if you missed anything or you want to go back through, you can certainly do that as many times as you would like. So Taylor Dye is our DSCR specialist. As of, I don't know, we've been working together for the last 3-4 months probably. And Taylor has extensive experience in this niche of the industry, even before DSCR was sort of a popular acronym. And so he has been a wonderful addition for us and a great resource. And many of you, well, maybe not many of you, but some of you may have already talked with him or potentially referred a possible client as well. And if not, we'll make sure that those of you that would like to connect with Taylor, I will get his contact information. I've got a couple of slides that has his info on it, and we'll get it added to the chat as well. But Taylor, if you could, before we get into DSCR, maybe take a minute or two and just introduce yourself and give the folks hanging out with us here some of your background.
Yeah, absolutely. Thanks, Josh. And so my background, basically, I got into the business in '96. As back then it was mainly we were doing 125% CLTV second mortgages. That was kind of with a hot product back then. And then eventually
repeat that. We won't even
what time?
we won't even repeat what that.
Yeah, exactly. And then the Russian ruble crashed, and everything kind of went sideways. We had a little correction there, and then I got into the subprime days. I was an account executive at some of the bigger lenders, and for all the bad press subprime got at the end, there were some companies that were relatively responsible, and I like to consider myself one of that I worked for those companies.
Yep.
And then I took a small break in 2008, obviously, and got back in to the market when I saw the non-QM space sort of maturing, and there was a lot of interesting products. I like creative loan programs. I don't, Fannie Mae, Freddie Mac, FHA, they're all great, but they're a commodity. I like loans that really solve problems for people. And so the first thing that really attracted my attention was the DSCR loan. And what I love about it is you can qualify really based on common sense. Does the property support the payment or not? It doesn't matter what somebody's personal income is or what somebody's employment record is.
Yep. And so for those of you that don't know, DSCR stands for debt service coverage ratio. Debt service coverage ratio. And so maybe a good place to start, Taylor, would be what is a simple way that someone can calculate the ratio? And then what does that ratio mean? Like, why is that important or relevant?
Yeah, absolutely. So the simple way to think of it is rent divided by PITI and A if you got an A. So principal, interest, taxes, insurance, and association dues. So if that number is one or better, it's a cash flow break even or positive cash flow property. If it's negative, then it's losing money.
Yeah.
And both scenarios can be done, but we have more options, better rates, higher LTVs when it's a positive cash flow property.
Yeah. So anything one or better, we have more options. Anything less than one, options exist, but they're a little bit trickier to qualify for. And also, just from a, from a investment perspective, it might, or, there might be an extenuating circumstance why someone would want to do that. But, generally speaking, if we're investing in real estate for cash flow, if it's below one, that means we've got negative cash flow. We've got an alligator, uh, eating all the cash flow, and then some.
Yeah,
Jewel,
usually that's
and
going to,
folks, go ahead, Taylor.
well, I was
Sorry.
just going to say, usually, we don't run into a lot of that because of what you just mentioned. Not a lot of people are buying negative cash flow properties intentionally.
Yeah.
But usually when they do, it's because they have another plan. Either they're going to do short-term rental, mid-term rental, or student housing. And so they're comfortable with the return on that property.
Right, right. So okay. So let's double tap on that, because you mentioned that you kind of. So what would be an extenuating circumstance that might make sense? And then Jules, we'll get to your question. And one thing I didn't mention in the housekeeping items is please, 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 we want any and all of your questions. And even if you have scenarios, etc., I find that in many cases is the best and most valuable information for those here. So those scenarios that might warrant a less than 1-to-1 traditional ratio, like if we're looking at it from a traditional perspective.
Was that a question for me, Josh?
Yeah, sorry. I wanted you to reiterate those scenarios where
Oh, okay.
maybe where it looks like it's less than one, there might be an extenuating circumstance or a reason why, a
Okay.
logical explanation for it.
Yeah, so they could, for example, they're doing student housing and they're going to rent it at a premium per room. And so even though one thing to step back for a second, when somebody's buying a property, and let's assume it's a single family residence and it's somebody's primary residence, the departing seller, it's their primary residence. There's no tenant. The lender doesn't have lease agreements. They're using the appraiser's opinion or analysis of the market rent for a long-term rental.
Mm-hmm.
So that's one of the factors that would, we're at the mercy of the appraiser's opinion at that point. We can always.
That is a 1007 appraisal, right?
Yeah. 216 on the multifamily, 1007 on, it's a form in addition to the 1004. Yep. Yeah. And so, so just keep that in mind as we're talking. Sometimes people are going to come back with a lower DSCR simply because the appraiser's coming in low on his rent analysis. But that appraiser is looking at the data he can find and assuming a long-term rental, like the family is going to rent it.
Yeah.
So the investor, the buyer may be looking at doing student housing, Airbnb, some sort of traveling nurse, medium-term rental type,
right?
Plan that makes sense for them. Or it could be a value add. Maybe they're going to, it's a California property. They're going to build a junior ADU and a converted garage, and they've got a plan for it.
So those would be the extenuating circumstances, let's say, or common extenuating circumstances where the actual rental income doesn't match up to the projected rental income based upon the appraisal, right? And these are the kind of conversations and things that Taylor will be looking into, digging into with you or your clients as he explores the best option or options given the scenario for you. Jules asks, so your floor is not 1.25 as far as a DSCR ratio?
No. Yeah. No, we have, basically it goes anything above 1.25. A lot of lenders are going to give a rate reduction because it's a less risky loan. Down to 1 is just, what you call the par rate. And then once you get below 1, it's negative cash flow. It's usually 7.75 up to 0.99 it's going to be a higher rate, limited number of lenders, and a lower LTV. But we also have lenders that even go no DSCR, so it's a no ratio DSCR loan.
Right, right. So don't assume that there aren't options if you have a ready, willing, and able borrower, client, etc. The options may not be ideal, let's say, or they might not be pretty, or as pretty as they might look if it was 1+ or even better, above 1.25, right? And that's where the premium pricing is. But never assume that there's not options out there. Taylor is ready, willing, and able to explore any scenarios. Again, we can't guarantee that we can make every scenario work, but we're at least willing to take a crack and see what we can do. Okay, so we have a basic understanding of DSCR. As far as what the personal income or employment of the borrower is not not what the income is based upon in these scenarios. But let's talk about the other two pillars, because Jordan and I often on these sessions we talk about the three pillars being income, credit, and assets. Right? Anytime you're looking for financing options. So the income is going to be the income from the property. But when it comes to credit and assets, what are some of the guidelines or what you're looking for, and where are some of the breaking points where we have better options versus we have some, but they're not great? Let's break that down a little bit. And actually,
Okay.
let's start here, Taylor. Let's start.
Yeah.
What are the asset requirements? How much reserves, generally speaking, are lenders looking for?
On a purchase, generally, it's going to be 6 months of reserves, seasoned for 60 days.
So 6 months reserve, seasoned for 60 days, meaning that they can pay the PITI for 6 months, and the what they're using to document that ability has been in some kind of account for 60 days or longer.
We can paper trail it. We can, it's generally not a loan. It's funds that they have in liquid.
It could be in a retirement account. It could be cash or checking or savings. Obviously, it could be cash value in an insurance policy. But it's got to be at least 60 days season. 6 months, 60 days season. Okay.
And that's just the general rule. There are some lenders that are going to have, but that's in general, most lenders have that requirement.
Yeah. Okay. So that's pretty simple and straightforward. And that's on a purchase. How are the reserves calculated or factored if they're doing a refi, whether it be rate and term or cash out?
So again, it's going to depend on the lender, but generally the cash out will count towards the reserves or completely cover it.
Yeah.
And below 65, generally you're not going to have a reserve requirement with the lenders I like to use, but
okay. So below 65% LTV.
Yeah, somebody's putting 35% down, or they're only doing a 65% loan to value refi.
Yeah.
Or purchase. They're not going to have reserve requirements.
Yeah. Jules asked, is that to remain constant throughout the life of the loan? Well, I don't know how they wouldn't be able to. That's just
at closing. Yeah.
Yeah. That's just to qualify. That's
so after their down payment and closing costs, six payments left.
Okay. So assets, we've got that pretty clear on that. Now, credit. So let's talk about some of those, where the benchmarks are, and maybe even, of the 3 scores, which one are there lenders that we work with that'll take a soft pull? There's a lot to unpack with the credit pillar.
Yeah. So generally speaking, we'll go down to a 575 credit score. But the higher the score, the better, obviously. The better the rate, the higher the LTV, et cetera. So 660 is kind of the sweet spot where there's a lot of lenders that we can choose, and shop rates. But all the way down to 575. And generally they need to have a, reasonable trade lines, like a $5,000 installment loan for 24 months. And yeah, I mean, it's bankruptcies, big credit events, housing events, things like that should be seasoned, 48 months.
48 months. Okay, that's important to know.
Yeah,
Yep.
just in general, I mean,
Yeah.
there's always going to be a lender that's going to take an edge case, but
Yeah. So I want to reiterate a couple of things. Because we didn't even get to the LTV thresholds yet. But as far as credit, theoretically, we can go down to a 575. But you and or the borrower need to understand that, the it's harder to qualify the other factors at play because it's going to be a higher rate, which is going to affect the DSCR, the actual ratio that you can. So I think a good way to look at it is the better the deal, the more likely we are to be able to find some extenuating circumstances on qualifying, right? So if it's a great deal, in other words, they're getting a great price for the income that property generates, then it becomes a little bit easier to make the other pieces of the puzzle fit together versus a deal where it's thin. We oftentimes that's going to be the deal breaking. Is that fair to say, Taylor?
yeah, absolutely.
Yeah. So 575 bare minimum. 660 is where we see a significant increase in the options and the better rate terms, fees, et cetera, right? Now, what about LTV ranges? So you already hit on the fact that 65 or below, many lenders, there are no reserve requirements because they're protected because of the equity spread. But where, generally speaking, whether it be purchase, well, let's unpack all of them. Purchase, rate and term, cash out. Where are the LTV ranges, and what should everybody here be aware of as far as that goes?
Okay, so the minimum down payment is 15% on a purchase. The maximum cash out refinance is 80% if you're doing cash out, 80% rate and term really too.
Yeah.
And just for example, a cash out refinance, which is important because that's where a lot of investors are getting their down payment for their next purchase. Right. But yeah. So even with the purchase, if you're an agent mainly doing purchase business, with the investors, you want to pay attention to that. But 80% cash out refi would require a 720 score. And then what was the other question?
So okay, so we can do a purchase with as little as 15% down. Once again, the making the ratio work at that number is going to be a critical factor.
Yeah, okay? Very difficult. Because the rates probably in the tens when you're taking advantage of that. So,
which is another example, just like the 575 credit score, it's got to be a great deal, right? That's what it comes down to. Okay. Yeah. And if it's not, they're going to either need to find a way to get more down payment or to improve their credit or both to make the ratio work, right? To get to a point where the numbers make sense, where it quote unquote pencils. On a cash out refi, 80%, 720. What about 75 or 70%? What are, generally speaking, the credit score minimums for a let's say, I've got 50% equity. I'm at a 50% LTV and I just want to get 20 or 25% equity to try and acquire a new property.
So to get down to 50%, I mean, we're going down to, again, that would be like 575 score would be at 50%.
Well, no, I'm sorry. Let's say I'm at 50 and I want to do a cash out refi to pull out 20 or 25%. I'm not going for the max. So because I don't have a 720 credit score, let's say, what kind of credit scores would you be looking for if I was doing a 75% LTV cash out or a 70% LTV cash out or even 65%?
So you're going to probably be, and there's lots of lenders that we can shop it with, but generally speaking, 680 is going to be a good LTV or a good score for 75, 660 at 70. 640, you're going to maybe get to 65, 70.
Okay.
Really depends on the lender.
Okay, perfect. All right. So let's pivot a little bit to when we think about a checklist of what you will need from a borrower in order to proceed, right? I mean, there's one thing to quote it, but what typical documentation is needed from the borrower if we get to that point where we're ready to, we want to proceed with the purchase or the refi when it comes to DSCR.
So documents from the borrower would essentially be, what we're gonna for a purchase would be the purchase agreement, their bank statements, 2 months of bank statements showing that they have the reserves if they're required, and the closing costs and down payment. And then, and ultimately we're going to get an insurance quote
Yep.
with an invoice. Needs to be a landlord policy, so they've got rent loss coverage. And we'll order title, so that's not coming from the
Right.
borrower.
Right.
So
pretty
really,
simple.
it's pretty simple. Yeah.
Yeah.
Driver's license.
Yeah. Compared to some documentation on some other QM type products, it's generally speaking a lot less documentation as far as that goes. So that's a big
Yeah. I mean,
plus.
I've done loans for borrowers where I still don't know what they do for work. I mean, it's just, I can look at the credit report and see what it says, but
yeah.
Yeah.
So one thing we haven't hit on, generally speaking, loan minimums.
So 100,000 is kind of the minimum where we've got lenders at play.
Yeah.
Once you get over 150 minimum, almost all of the lenders in the space are going to be in play. And then we have a few lenders that'll go below 100 down to 75, and one lender that has no minimum, but we hit predatory lending, just so it's limited not by the lender but just by regulations.
Yeah.
So there is a limit, but
and generally speaking, 2, 3, 4 million max on the high end. I mean,
yeah, 5 million would be kind of at the top end. We have lenders that'll go higher case by case up to 10 million.
Yeah. And one thing we didn't talk about is property types. Single family, 2, 3, 4 unit. What else would fall into this arena?
Yeah, so everything we're talking about right now is generally in the residential property space, right? So nothing commercial, nothing over 4 units. So multifamily up to 4 units, condo, warrantable and non-warrantable, manufactured homes, even if they're on their own land and plates retired and it's real estate. And of course, single family residences.
Detached. What about above 4 units, mixed use, things of that nature? Is that something that you can still help with?
Yeah, we have lenders that will do all of that. But mixed use is there's very little appetite for mixed use right now. We have commercial, residential, but greater than 4 units, we're now in the commercial space, and a lot of these residential DSCR lenders will still treat it like a true residential loan up to about 8 units. And then after that, we're really starting to look at more of a true commercial deal.
Okay. And for those that have if you have a scenario, whether it's for yourself or for a borrower, we have a simple form. I'm going to put it in the chat here. And I also did drop Taylor's contact information in again as well. We have a simple intake form that asks some questions about the deal, and that gets at least enough information for Taylor that he can go and at least do some preliminary work to put together quotes to see if it's something that we can help with. And then generally speaking, I would say in most cases within 24 business hours, Taylor will have some preliminary quotes. He'll email that. If it's for a client of yours, of course, we'll CC you and keep you in the loop on that. I did want to put Taylor and my contact information on the screen as well. I've been putting it in the chat. We've got the QR code set up as well that I'll explain what those, one of them, the bottom left, I believe, goes to that DSCR intake form. The top right is for those that have been thinking about or wondering about being dual licensed as a real estate agent and loan officer, which is what I am. Taylor is not, Jordan is not. But that's how I got into the industry. is with our what we call our reload program. And if that is something that is of interest to you, you can scan that QR code. There's a short video, and then you can schedule a time to chat with me if you'd like. Taylor, what else when it comes to DSCR? What didn't we talk about that folks should know or be aware of or be thinking about when it comes to this topic?
I would say something that comes up a lot is the cash out refinance without seasoning. A lot of people are interested in that. And we do that 80% cash out refinance on properties with less than 12 months or less than 6 months of seasoning on title. However, it's not just a no problem type of, yeah, we can do that. What has to happen is there has to be a reason why that value increased. So if somebody bought a property for 200,000, it's worth 300,000. The lender needs to know why. If it was because they added a lot of value to it, renovated it, then the appraiser should document that in the comments. And the lenders will run a second appraisal at their expense, but a second appraisal needs to be within 10% of that higher appraised value, assuming our appraisal came in higher. And it's still, at the end of the day, a subjective decision, even though those are the guidelines.
Yeah.
So but it's doable. We do it.
So for those that aren't aware, no seasoning. So a scenario that I've had come up is seasoned investor. They buy a property cash. Maybe they buy it at auction, maybe even tax auction, foreclosure, whatever the case may be. And they want to deploy the velocity of money, right? They want to try and get that cash back out. A lot of times they have to wait 4, 6, 12 months. That's the seasoning aspect. And what Taylor just shared there is we might be able to help theoretically, right? We can help with that. Each scenario is unique and different, and ultimately it comes down to the lender rubber stamping it yay or nay. But it can be a great way for you to help your clients turn their capital faster, right?
Yeah.
It could, and a lot of times what happens is, well, maybe not a lot of times, but I've had this scenario where investors didn't anticipate being presented with another great deal, right? The seasoned investors, because they've been in the game a while, they have a lot of contacts, they have a lot of network, et cetera. And oftentimes, deals pop up for them that they weren't exactly planning on. But a deal is a deal, right? And so, I get people commenting and DMing me on Facebook and Instagram pretty frequently around that scenario, that that being able to cash out with no seasoning. So that could be a great, a great hook or conversation starter if you've got a database that has investors or projected or prospective investors or investors to be, as a great way to initiate a conversation and get a conversation going with them. What else, Taylor, if anything, should folks be aware of as it relates to this topic?
Well, just going back to the previous topic about the cash out, if somebody they buy a property all cash, we can do delayed financing on that. So that's a different issue. And delayed financing, basically, it's a better loan because you're going to get it's not considered a cash out refinance. Somebody buys it with cash. Now they can essentially refinance, but with purchase terms. So a lower rate than a cash out refinance. And that LTV as if it were a purchase, not a cash out. So that's something to keep in mind there. It's different, a little bit different than the title seasoning issue about trying to do a refinance at a higher value than the property was purchased at, which is what I was talking about.
Yeah.
So just want to point out that difference. And then another thing that would potentially be an issue is, or not an issue, but something to consider is we can close in an LLC. So we can close in an LLC or in a real person's name. If there's multiple investors, we used to have to use the lowest of the lowest credit score of the multiple investors that we're buying. But in that case, a lot of times we just drop off the low score investor because we don't need their income. It doesn't matter. So we just drop them off. But now we can actually use the highest score investor. So if for some reason that creates some, block or struggle with the partners, and how are we going to do this if you're the only one on title? That's one of the solutions that we have.
So I want to take a few minutes to pivot slightly to address, most of you attending here, most of our audience is agents. And while I hope this has been educational for you, informative for you, you may be wondering, what are some practical strategies of how I can take this information and generate more opportunities? I want to give you a couple of thoughts or ideas. Number one, we have in our free members area, wakeup.real estate, in our free members area, we have several lead capture pages that you can use on social media, in email, text message, even if you want to drive traffic to them, pay to drive traffic to them. One of which is, there might be more than one, quite honestly, is related to DSCR options. Let me get out of here, and I'll pull that up. So that would be one way that you might take the idea of DSCR financing and create some conversations, some lead flow, some opportunity flow for yourself. So if you go to wakeup.real estate, you can create a free account, and then mortgage lead capture pages. We have a whole bunch of different pages. No income, no employment. We got cheap hard money, which is we're going to have Taylor back on real soon about hard money. Well, maybe we don't have one for DSCR specific. Well, we'll get one up there for DSCR specific. I thought we did. We have creative self-employed. We'll get one. I'll get with Ryan, and we'll get one up here on that specifically real soon. The other or another strategy for how you can use this is proactively in your market, identify a property that could be a great investment, and get with Taylor or I. We can help you see if it pencils, and then you can present that as, here's a potential turnkey investment property where we can theoretically it qualifies for DSCR financing. Okay, it doesn't mean you as the borrower will. If you've got a 500 credit score, that's going to be a problem. But from an income perspective or a DSCR ratio perspective, this looks like it would make sense and qualify, right? So you can proactively, be using that as a way to bring the client to you. I think in most cases, and I'm guilty of this as well, we wait for the client to dictate going to find the deal or the property. You're reverse engineering it, right? You play the role of investment detective and go and find a property in your market, in your MLS. Maybe it's been sitting for a while because they priced it too high to begin with, and cosmetically it's a little rough, whatever. But from an investment perspective, it might make sense, right? So you proactively go out and identify that and put together a prospectus on it, right? Like, and then present that to your audience, social media, your database, your email list, etc. And it doesn't mean that you're going to sell that property to someone on the list, but it gets you in conversation. And maybe maybe they had already identified a property that they wanted to buy, but they didn't have the cash, but they have other assets. So we can find a way to piece all of that together. But you've got to take the lead and initiate some of those opportunities and create those conversations. Anything else from that side of things, Taylor, that you've seen that works well for the agents directly as it comes to these kind of
Yeah, I mean, I would say that so a DSCR loan is permanent financing typically. So and lenders are looking for rent-ready properties. They're not looking for a property that needs to be renovated. But as we know, there's a lot of people out there, a lot of investors that are buying fix and rent type properties or
yeah.
fix and flip type properties. But the ones buying the properties, they fix them up and want to hold them as rentals. They're going to need to get out of that renovation bridge loan, and the DSCR is typically the way they do it. So targeting, properties that have sold and were obviously in fix up condition, that that investor is probably going to re-up soon.
Yeah. Well, and maybe we did this in reverse. I don't know, but let's go ahead and say that whether it's next week or the following week, I want to get back on and have you back to talk fix and flip and hard money options because that perfectly leads into this conversation, right? They can use that type of funding to acquire, then they can put a permanent loan in place, a DSCR permanent loan in place, and then do the whole, do the game all over again. And the nice thing about that for you as an agent, if you're building a clientele around that, it becomes a nice little repeat and referral business if you can be the deal maker, right? If you can be the one who's finding opportunities for them. Jules says, with an anticipated rate cut coming, is there a penalty for early payoff?
Typically, there is. It depends on the state. Like Pennsylvania, there cannot be a prepayment penalty.
Yeah.
Several other states, but yeah, there's usually a prepayment penalty, and I would say a lot of people quote it at 5 years, which is the maximum prepayment penalty, but it can be bought down or bought out, anywhere from 0 to 5 years.
And neither Taylor nor I are mortgage rate prognosticators, but that is a moving target because 3 months ago, 6 rate cuts were anticipated this year. Now we're down to maybe 3. So, the thing that I would lean on, if that's an objection you're hearing, is, hey, if the numbers work today, waiting is only going to, the prices are only, generally speaking, have only gone up, right? And from an investment perspective, if you can get it to pencil today, let's get the sooner you acquire it and start building equity through forced appreciation, maybe through the amortization, pay down, et cetera, the better position from a wealth perspective they will be, right? The sooner you acquire an income producing asset, the better off you are, generally speaking. And Jules, I'm not sure what state you're in, but we can address whether or not you're in a state that doesn't have, like Pennsylvania is a state where they can't have those. Now that does also play a role in the rate and fee and so forth, right? So
Yeah, exactly. There's no free, no prepaid. They're buying it out.
Right. Yeah. Right. Yeah. So, but great questions, Jules. So let's come in for a landing here, and I'll mention again. I'll pull up the slide here again that has Taylor's contact information and my contact information. If you have questions, if you have a scenario, whether it's yourself, right? Because these are great loans for those of you that are in the industry, right? Because if you find a good deal and you've got the assets and the credit, your income is irrelevant. So and you're hopefully you're looking at inventory every day. And when you come across one, and if you do the exercise that I mentioned, you might just find a deal that you want to do, versus you might want to keep it to yourself and not put it out there to your database. Taylor is extremely responsive. I've heard nothing but wonderful things from everybody that I've referred to him since he has become part of our team, whether it's agent or borrower directly, investor, client directly. His cell phone's here, his direct email as well. If you have a property yourself that you'd like to get quotes on, it's joshvips.com/DSCR. That link is in the chat. And if you just want to connect with Taylor, because this is something that is of interest to you, and you anticipate the possibility of having scenarios or having clients, or you'd like to build a pipeline around this idea, you can schedule a time to chat with him. Or from the marketing perspective, if you want help with the putting together a marketing concept to build a clientele base or a pipeline around focusing on investor clientele, I'd be happy to chat with you as well and game plan on that. And my calendar is josh15.com. Josh15.com. Taylor, it looked like you were gonna say something there, but maybe
Well, I was just going to say, yeah, absolutely. I welcome anybody to reach out and, ask more questions or, run some scenarios, even if they're just hypothetical.
Yep.
I'd love to help.
One last thing, the replay, the recording of this will be available immediately after we hit the stop webinar button at the same link that led you to the session here. We'll also get the recording uploaded to our YouTube channel, Wake Up Real Estate, and our website, wakeup.realestate. We'd love the opportunity to work with you and to help you with any loan scenarios that you may have. Taylor is our DSCR, our hard money, our commercial. But we do have some great folks when it comes to the more traditional financing as well. Not Taylor's cup of tea, but we can help with those FHA, VA, conventional. And so we'd love to, to win that business as it comes up for you as well. Thanks for spending some time with us here on a Tuesday afternoon. Taylor, thank you for spending time and sharing your expertise. And we'll be back next week with another mortgage info session to help you all help more clients and close more deals.
Thanks a lot, Josh.
Thank you.